We have US manufacturing jobs down, stock surges because of speculative Fed rate cut, and CPI news data from October canceled. Let's get right into it. So, here we have the US manufacturing jobs have plunged since Trump's tariffs. This is bad because this drops GDP and makes us rely more on imports and exports because we're not manufacturing here much. We also have the US stock surge on growing likelihood of Fed rate cut next month. Now, why is this bad? Well, because when market rallies, that usually means investors notice that the market is weakening, which is not good for news for many people. We also have the US cancels release of CPI report for October because of government shutdown. This is really bad because this means that we're going to lose trust in them. And, since they're not being transparent, that is not very good. Although most of us know that CPI is more like CP lie because usually they lie about everything. Anyways, onwards, we have while the near term forecast is revised up modestly, global growth remains subdued as the newly introduced policies slowly come into focus. This is bad because this is corporately, globally bad for income, earnings, weaker trade, and investments. We also have higher unemployment because of this. Now, you guys might be saying, what? This is just news. Sometimes it lies, sometimes it's not credible, but I'm here to tell you it's pretty credible. We can go ahead and jump into the charts now. So here we are in the charts. But first, if you guys really enjoy me comparing charts to the actual news to give you guys a better visual representation, I recommend you subscribe and like the video so you can get more of this content. So, we have the dollar. We were saying that we were having weaker jobs and the global economy is getting affected. Well, we can also see that here in the chart. We have the dollar, and you guys know already that if the dollar goes up, we have an issue with liquidity, which is needed so we can have more inflation, healthy global economy, macro wise. But you can see this is the indicator, this big yellow line is telling us that we have bullish momentum going up, which means the dollar is going to continue to get stronger. Now, you guys might be saying, well, that's just one thing telling us that we are going into a liquidity crisis. If you guys haven't already seen some headlines, we are already in a liquidity crisis. We also have Bitcoin. This is one where everybody loves saying it's going to go to the moon. We also see here that it closed below the 200-day moving average, which means we have more support to the downside, essentially. As you guys can see here, Bitcoin has dropped down, and I am going to assume it's going to find support here at 78,267. Will it find support there? Maybe. Can I find support before that? It could. But that is where my line in the sand is. Now, you guys are wondering, why are you showing Bitcoin? Well, that is because it is a speculative asset. And speculative assets usually go down during liquidity crisis, which is going down right now because we have a liquidity crisis. Now you guys are like, okay, two things. I want something else. Okay, very well. Let me pull up another chart for you. This is the US dollar to Japan futures. So this is the US dollar relative to the Japanese yen. And if the US dollar gets stronger than the Japanese yen, we have a liquidity crisis. When the US dollar and yen are going down, we actually have a more liquidity out there in the markets. But as you guys can see here, this is on the weekly time frame, by the way. that we broke out of a pattern going up, and it looks like we're going to keep skyrocketing up. And let me get you your measured move. Right here, we have a set price target of 71 171 and 31 cents, which means bye-bye everything. You guys may also be saying, but yields are coming down. Well, let's go take a look at that. So here is your 10-year government bond. I mean, yield. It's your government yield. So when yields go down, usually stock market follows as long as the stock market has a catalyst, such as, CPI, FOMC, jobs. So here we have a head and shoulders pattern that we pointed out on Wednesday. And if you guys look carefully, if you pass this right shoulder with the price action, that invalidates the head and shoulders pattern. And that means what I'm saying can longer be held true, which was on Wednesday, I was saying we could go up. Now I'm saying, well, price action decided to take a different turn, and now we want to go down. Now, why is the yield bad when it goes down? As I just explained, when yields go down, it's not good for the stock market. That means your bond market actually goes up because people are chasing security, and you are more secure in a bond rather than in the stock market. So let's go ahead and take a look at the bond market. So here is TLT. This is the tradable symbol of the bonds. And as you can see, we had a head and shoulders pattern. But if we break that right shoulder going up, that means we go up higher. And essentially, bond market goes up, yields come down, and stock market, as long as it has a catalyst, comes down. So that is what we're looking at right now. So in summer, we have jobs and manufacturing disappearing. We don't have our CPI news data from October. And globally, everybody is stressed. And I just showed you guys in the charts that everything is actually stressed and it's about to get really, really worse. So, what can you do to fix this? I would recommend starting a business. Like I said before, go ahead and wash your neighbor's trash cans, power wash them or whatever. Make them squeaky clean, charge them like $10, $15 each trash can, and you just keep doing that one after another. Keep cranking that out. Or you can figure out how to trade equities. And I will see you guys next week.